All right. First of all, I want to thank everybody for being here. Me and Steve want to put this together to do something a little bit different than what we normally do. There's a good chance if you're on tonight's webinar, you've found me and Steve online in some capacity, whether that's our main YouTube channels or the podcast channel, or maybe you're just one of the clients that we've worked with previously that is on this call to learn about the buying process. Our goal tonight is very simple. I'm going to share my screen in a second, and we're going to go through quite a few slides. And the main idea is that we're going to cover essentially all the things that we wish we knew before we bought our first properties. Tonight's call is not going to be about if renting's buying or if buying is better. All we're going to really focus on is like if you've decided that home ownership is something that is important to you, that you're trying to get into the next little bit. We're going to go over all the things that we go through in depth with all of our clients. So I want to thank everyone for being here tonight. I'm going to share my screen in one moment, and we're going to get right into it. So tonight we're calling it the first-time homebuyer blueprint, and what I mentioned previously is this is really the blueprint that we go through, and the blueprint that I wish that I had when I bought my first property when I think I was 23 or 24 years old. I kind of just went into it blind, and it worked out because of the market conditions at the time. But going back to if I was going to do it again, this is everything that we want to make sure that you fully understand. Next up, just to get ahead of the questions that will be coming, yes, you will get the recording. We will send it to everybody, and we are recording right now. And the second question that we want to get out of the way is, yes, you will have access to all the slides. So if anybody wants these, I can just automatically send it out after the call, so you have access to them as well. And this is what tonight's agenda is going to look like. So we're going to really hit on I guess 5 main topics, and we might go a little bit off path a few times here, but there's 5 things that I think are really important that we're going to focus on. Number 1 is the savings accounts to take advantage of. I think a lot of people are excited, Steve, when that first home savings plan came into effect, the savings account that Canadians can use to buy their first property. I still very much believe that it is the best thing the Canadian government did to allow people to get into home ownership. And we're going to go through exactly what that is with the down payment, the minimum down payments that you're going to need to buy any property across Canada, what it means if you have to get mortgage insurance, and why is your rate actually lower if you're putting less than 20% down? We'll walk you through all that because that's usually, I find, a head scratcher. And I'll also say too is some people on the call tonight will watch what we're going through and go like, oh, I know that, or I know that. And we're trying to keep it as simple and straightforward and entry level as we can, just to make sure that there's no surprises for anybody else. We're going to talk about the mortgage approval process, how the bank approves you, and your options when you are getting a mortgage. And that could mean using a mortgage broker or going right in directly with the bank. We're going to talk about the offer process, what can happen when you make an offer, and the educated buyer framework that we believe is extremely important throughout this. Now, I work here in the city of Toronto and the Greater Toronto area. Steve works in Surrey, Fraser Valley, and the Greater Vancouver area. But this is a Canadian webinar tonight. So what we've done as well is at the very end of tonight, we will have a QR code that you can, and we'll also put it in the Q&A as well. And essentially, if you're trying to buy in any market across Canada and you don't have someone you trust, we've already pre-selected realtors that we trust that run our businesses as seriously as Steve and myself to make sure that you're going to be put in the best position. So let's get into it with all that out of the way. My name is Tom Storey. I've been selling real estate for about 13 years, started when I was 22 years old, living in my parents' basement, and we've turned into one of the top condo teams here in the city of Toronto. We do about 100 transactions a year, and it's been really neat to start working with first-time home buyers 10 plus years ago and watch them then sell that condo and buy that house and then have their first kid. It's been this really cool journey, and I've done a lot of media as well, but this is the guy you came to see tonight. This is probably the only time you'll ever see Steve in a suit jacket. Steve, why don't you quickly introduce yourself?
I was going to say, I'm not wearing a suit jacket. Yeah, I've been an agent I'm in my 18th year now. I kind of did it the right way, I would like to say. I mentored under somebody for a long period of time. Thankfully, I have a very rewarding business and loyal clientele. I don't like to brag, but we are top guys in our office and top 1% in our board. So we like to say we do a lot of transactions. We know how it all works well.
And for those that maybe found us on the podcast, you'll already know about it. But if you're maybe new here and you don't know, the way me and Steve know each other very well is we've been doing the Tom Storey Show. We just recorded today, I think, episode 197. We're coming up to a huge milestone episode of 200. And the next two guests that we have booked are probably two of the biggest guests we've ever booked on the show. So make sure you get subscribed to that channel as well if you want to follow along after the fact today. More importantly than anything, we're going to walk you through the process today. We're only 6 minutes into this call, but I wanted to get all of that out of the way right at the beginning. Here's what I really believe is the most important thing. I don't think anyone should learn from someone that hasn't done it themselves. Even though I don't think I did it the perfect way when I bought my first property, I wanted to share with everyone on this call what my experience was. This is my first condo. It was in downtown Toronto. For people that know Toronto, it was in King West on a street called Stewart Street. The condo was actually 32 Stewart Street, and it was an older building. It was 640 square feet. It didn't have a balcony. It didn't have parking, but I liked the fact it was this loft. And the coolest thing for me, so I bought this in 2015, and I was 23 years old at the time, or I was probably just turning 24, and I decided to live with my parents until I saved the down payment necessary. And I'll be very honest with everybody on this call. Like, I got help from my parents to buy my first property for two reasons. I was self-employed, so my dad had to co-sign for me, and my parents did loan me, I think it was probably $30,000 to help with my first purchase. So just to be very upfront with everybody, I didn't do it 100% on my own. I paid $360,000 for this condo. Eventually, when we sold it, I think it was in the $550,000 range, but I sold this to upsize to the next one. And even though Steve is basically, I mean, he was around when the dinosaurs were around. This was his first condo. I'm surprised how expensive it was for how old you are, Steve, but can you explain your story?
Yeah, my story was I decided one day I wanted to be a homeowner. I had no idea what to do. Thankfully, I was put in good hands of an agent back then, way before I was in real estate. And I just wish we had the opportunity to learn something like this back then. You just didn't have it. You just went to an agent back then and you kind of did whatever they told you to. I picked out a unit that I liked. I wish I would have known more, as I said, but honestly, for me, the feeling of home ownership when I sat down on my couch for the first time and like put on a football game on a Sunday by myself with a beer in my hand, it was like, I'm like, this is it. This is fantastic. So I wanted to spread that feeling to other people. So a few years later, I ended up with my real estate license and I've been helping people ever since. So for me, it's like the feeling of owning your home more than anything. And you can't explain it until you're there.
I remember when I had my housewarming for the place that I bought my first place, and everyone that came in is like, "What do you pay for rent?" I remember being like, "I own it." Like, it just felt so good having that conversation. All right. I know there's some people from Alberta here tonight, so this will differ for you as well. But depending on if you're watching from BC or Ontario, there is some key differences. And everything we're going over today is a general overview, but specific conversations we can have with you after the fact if you want to book meetings with us. The deposit amount in Toronto, it's typically 5%. In BC, is it slightly lower than that, Steve?
Deposit amount, we shoot for 5%.
Okay.
You're not going to be taken seriously with less than 20 grand.
So what we found though, so that adds up about the same, but the timing is different in Ontario. If you get an accepted offer, in most circumstances, it's due within 24 hours, where in BC, sometimes it's due several days later because of the cooling off period. Is that correct?
Particularly, not because of the cooling off period, but particularly in the lower mainland, it's become customary that the deposit is not paid until you firm up the deal or remove conditions.
Yeah.
So that's a big difference. I know in other parts of BC, it'll actually be upon acceptance as well. So if you're in Ontario and a lot of parts of Canada, when you're writing offers, you need the money. In BC, usually it's 5 or 7 business days later when the conditions are removed.
Why that's really important, especially for potential first-time home buyers, is because if you get an offer accepted here in Ontario, that deposit's due within 24 hours. So you want to make sure it's in an account that can be liquid. Basically, you can get the money out when you need it, and it's not tied up in some type of investment where it's stuck there. Status certificate is what we call it here for a condo in Ontario. In BC, they call it strata documents. The key difference here is that a status certificate in Ontario should only be reviewed and given advice on by a real estate lawyer. Where in BC, do the agents do it, or there's companies you hire there that are different?
I know in Alberta, usually what you would do is you would hire out a company, much like a home inspector.
Mm-hmm.
You would hire out a company to review the documents and give you opinions on it. Here, it is the responsibility of the buyer to review. However, the reality is most buyers don't know what they're doing. So if your agent is good and knows what they're doing, they're going to walk you through those documents. And then it's up to you to decide what you think of those documents. Particularly with one that would be the closest to the status certificate that you guys call it, called the Form B. But there's lots of pages of stuff here, lots of documents to review, and most first-time home buyers are obviously strata, so this would apply.
Now, in Ontario, we do not have a cooling off period for resale properties. If you buy new construction, you do have a 10-day cooling off period, but for resale, once that property becomes firm, that is a legal binding contract that you are a part of. Where in BC, even if your transaction is firm, you don't have conditions, which isn't the norm in this market anyways, but there is still a cooling off period, which, Steve, how long is it right now? Is it 3 days or 5?
It's 3 business days starting the next day. So
Okay.
we're Thursday here. So if I wrote an offer today, it would be Friday, Monday, Tuesday. So you would have that much time to walk away from the deal for a fee. But given the marketplace right now, and that you're likely going to have conditions until next Friday anyway, it's written into the contract, but in most cases, it's not going to come into play.
Got it. Unless the market heats up and there's firm offers again, then it would actually make a difference, right?
Correct.
Okay. The first-time home buyer transfer tax and the rebate that you get differs as well. We're going to give real examples as we go throughout tonight. The agency disclosures, we're not going to get into it specifically tonight, but they are different for the different provinces. And this is the main one that confuses people. Here in Ontario, if you have a closing date, that is the day in which you get the keys and you take ownership. Where in BC, sometimes there's like a possession date and a different date. Steve, explain this to the people watching.
So completion will be the day that you complete on the contract in British Columbia. Some provinces will be you get the keys same day. Other provinces will be you get them next day. BC, it's negotiated. So often you'll complete and pay for your property on a Wednesday, but you won't get keys until Friday or Saturday. What that does is it allows all the properties to kind of line up and for people to move. There's nobody in moving trucks. It's really convenient. But then it does come with some challenges about insurance and those sort of things. So you got to know how to navigate it.
So those are the differences. Now, as we get into tonight, I want to show you just a few charts and graphs to get started, because I want to be upfront, and everything that we've told every buyer that our team has helped purchase properties over the last few years is the first question we will ask them, and the first thing I would say to everybody watching this tonight is, how long do you plan to own this property for? This chart you're looking at here is benchmark price. It only let me go back to 2005. I wish I could go further back, but this is where it capped me at. And this is for all of Canada. This is for no specific market. This is the entire country. So what we've basically seen from the financial crash of 2008 in the States is that we had low interest rates and the market really went up quickly because the rates were so low. We dipped off after April 2017 because we had a few things change, especially in the Ontario market with the foreign buyer tax and in BC, and they put in blanket rent control. And then this run up here was basically the pandemic run up. We had money under 2%. We couldn't travel. We were obsessed with real estate. We had crazy immigration numbers of people coming in. There was massive speculation, and it really, really peaked out here in March of 2022 for almost every market across Canada. Now, since then, you can see we've had a very significant correction. So I want to show all of you this today to say that real estate works in cycles. The upward cycle that we had here lasted much longer than usual. And if you look at where we are today, it's like it's kind of makes sense of where we probably should have been. We just took a complete roller coaster to get there. So the reason I'm saying this to everybody is that we don't know what's going to happen to the market in the next 2 years. And me and Steve can't come on here tonight and say you're going to buy a property and you're going to make 100 grand in the next. That's probably not the marketplace that we're in. Most of the people buying properties right now are because they're making lifestyle decisions and they have a very long-term perspective. So for anyone watching this, I would say if you're not going to own it for at least 5 years, probably mathematically makes more sense to continue renting. So I just want to be upfront with that before we get into more specifics. This chart I found interesting, and this came directly from Stats Canada with a survey that they did, and it just shows the difference in homeowner versus renter, just net worth basically. And you can see the numbers for yourself. I think there's also a big portion of this that obviously we had that crazy lift in prices for a long time, so that contributed to it. And I think there's a lot of renters that could have never afforded to buy a home, so they didn't have the chance. Their incomes were lower anyways. But you can just see, and one of the things that Steve's kind of really gotten in my head recently is home ownership. I find it's a great thing. I really like it. I'd say that long before I was in real estate. But Steve, one of the things that you already mentioned to me is like, well, wouldn't it be nice to get into your 50s, 60s, 70s and own something fully paid off? I know you have property taxes and not have a rental payment, because rent probably for most people on this call is going to be cheaper than buying a property, even with 10 to 20% down for most circumstances. So that's something that's always kind of stuck with me. And in terms of the three pillars I've always looked at for the Canadian market, things that I would track is immigration. So we know we had tons of immigration until most recently, where the tap has been almost fully turned off. The unemployment rate, and this is directly in your micro market as well, not just the entire country, and interest rates. So that is what I have been focused on for a long time in terms of making the videos on my channel and trying to give advice for what's going to happen. One thing that we have found recently, which is good news for everybody on this call, is that a lot of the times, most of the videos you're going to see online or chatter about the market is just like, well, we're down 20% from the peak of the market. And that is absolutely correct. It could be more than that in some communities that went up really fast. The good news is that the actual affordability and the changes that we've seen in the last 2 years have actually made a difference for buyers on three different levels. We've seen prices drop. So average price is less, which means your down payment is less, which means your land transfer tax is less, and the amount of debt you're taking on is also less. All those things are very positive. The second thing is that at the end of 2023, because I was one of the few people that had a renewal at that point, I can tell you interest rates were over 6%. At that point in time, the fixed rate was over 6% and the variable rate was even higher. That's when the Bank of Canada was still at 5%. So the good news is that the interest rate has come down from like 5.5 to 6 to 3.5 to 4. We've seen a decrease in price, and both those things combined means that when the interest rate is lower, the stress test that you're being tested at, which we'll get into more detail with you, is going to be lower as well. And I found it interesting in my own business, Steve, is that a lot of renters have come to me and saying, hey, we watched the market get totally out of whack, and now we're looking at it going like, well, maybe there's an opportunity. Maybe I can go in. So we just encourage everybody on these calls to run those numbers. Now, Steve, I want you to take over here and explain the first home savings account. If you're on this call tonight and you don't have this account set up, this is the first thing you're going to do tomorrow morning. So Steve, take over.
This is not financial advice, Tom Storey. No, but honestly, so this is a good tool that's now been put into play. Before, when you had to save for your home, you just save for your home. You put it in your bank account, and that was that. Well, now the first home savings account has been put in place, so it's a double dip. I love that. I love the fact that it's a double dip. You have two benefits to it. One, all of the money you put in to that account becomes a tax deduction like an RRSP would. But then two, the growth in it is supposed to also be tax free. Now, don't day trade in it, don't do anything like that, but you're going to have safe money. I think you could do different things with this money. I'm going to say, if you're saving for a home, let's go as safe as we possibly can, something like a GIC, but then you're going to save that tax when you're saving that money at the end of the year. You can get that tax return and hopefully save that as well and keep that kind of snowballing. The first home savings account is the spot I would start right now. If I have any savings left over and I want to become a homeowner one day, open that account today and put as much in it as you are allowed to. Now, I don't want to necessarily represent that it's this or this or this today, how much you can put in. Those do vary depending on how old you are. Every year, the government usually reviews these things and can change them. But if it's not maxed out, whatever your maximum is, this is the first place you should save. Then followed by the next account, which would be your RRSP. Now, I'm going to give you a little bit of a warning from my personal point of view with an RRSP. You can save in your RRSP, get the tax deferral, which means you don't pay tax this year, And then you can withdraw that money in order to purchase your first home. You have to fit within the parameters of the program. I don't want you to rely on this one if you don't need to. And the reason is you have to pay the money back. This is the part that gets lost. Like, if you have a long time to pay it back, but if you don't need to borrow from it to get into your down payment, I wouldn't also want to have now a mortgage payment plus a debt repayment program of my RRSPs. It's great to increase your down payment if it's an option and the numbers look right and you're dealing with your mortgage broker. However, if you haven't maxed the first home savings account, do that first. And ideally, I'm the retirement first person. That's why I want everyone to own a home so they don't have shelter costs. Ideally, you don't have to withdraw from your retirement fund in order to purchase a home. It is a tool you may use, however. I guess along with the TFSA, but do you have that much as somebody starting out trying to get into the business to have all those things maxed?
Well, and if you haven't taken advantage of your RRSP yet, I'd say I would be starting with the first home savings account because it gives you the benefits of the TFSA and the RRSP combined, where if you make $100,000 a year, you can put $8,000 in this per year. So your income's only being taxed at $92,000, which is great, obviously bringing down that. And then also the money that you're earning in this is tax-free. So this is where I would start. The only thing keep in mind with this is that in terms of what you can actually put into it, it does max at 40,000, but the growth can be much more than that over a period of time if you've invested in the right things. And we're not here to tell you what to invest in or how to put your money in there, other than the fact that this account does exist.
And you want to open it as soon as possible. So if you qualify, I don't know if it's 18 or 19 years old, but if you qualify to open one, open one and start that limit counting and put whatever you can to get in there for sure.
Absolutely. Next up, we're going to jump to the minimum down payment required in Canada. What I find for a lot of people that are looking to get into the market is they'll always say, well, I can kind of afford the monthly payments. I just don't have the down payment, right? And we had some pretty significant changes actually that came into place at the beginning of last year, Steve, regarding first-time home buyers and the minimum down payment changes for CMHC insurance and how long your mortgage can be. So as it stands right now, if you're buying a property in Canada, how it works is that on the first $500,000, your minimum down payment is 5% of that amount of money. So that would be $25,000. Okay. Now, anything from, this is obviously a massive range here, anything from 500,000 to 1.5 million. This used to only go to $1 million. The change we had last year pushed this to 1.5. 10% of that portion has to be the minimum. So just to give you simple math here, if you're buying a property for $600,000, well, it's 5% on the first 500,000, which is 25,000, and then $10,000 on the next $100,000 because that's 10%, right? So that would be a minimum down payment of $35,000. Getting in with a minimum down payment, there's pros and cons to that because of mortgage insurance. And just so people know kind of how it works, I don't think there's too many people on this call today that are going to buy their first property over $1.5 million. But if you are in that unique group, it's not like it's 5% on the first 500,000, 10% on the next million, and then 20% over. It's anything you spend over 1.5, you have to put 20% on the full amount. Okay. Just so everyone understands how the minimum down payment works. Now, mortgage insurance, what I want people to understand about mortgage insurance is if you put anything less than 20% down, you will have to have mortgage insurance. This is mandatory. And what I think a lot of people get lost with mortgage insurance is it's not actually for you. It's for the mortgage that you're getting. It's from the bank. That's who's getting the mortgage insurance. So it's something that you have to pay for because you're not putting 20% or more down on the property. So if you put 20% on a home or less than 20%, you must have mortgage insurance. Now, this is calculated based on exactly the percentage that you're putting down. In Canada, the insurance is provided by only 3 people. You've got CMHC, which I'm sure is a name a lot of people have heard from before. You've got Sagen, and you've got Canada Guarantee. So you don't get to choose which mortgage insurer insures your mortgage. That is chosen by the lender that you go to. Now, to break this down one step further, and I'm going to continue on my example here of using a purchase price of $600,000. Just so you can see here, at $600,000, putting down the minimum down payment, which ends up being like 5.83%, that's $35,000. Your mortgage insurance would be $22,600. This is essentially added to your mortgage amount, and then you're just paying for it over the life of the mortgage. You can see if you put down 10%, the mortgage insurance goes down. If you put down 15%, it goes down a little bit more. And 20% or anything over 20%, you do not have mortgage insurance. Now, something that's always
Let
been.
me answer a question for you
Please.
there that
Yeah.
for sure is going to come up.
Yeah.
No, you cannot
You
pay
can't get it
that
back.
out in advance.
Yeah.
You can't get it back, and you can't pay it in advance. It must be rolled into your loan.
Yeah.
So yes, you will be paying interest on that amount in the future, unfortunately.
Yeah. So that's something to keep in mind. Another thing that most first-time buyers don't know and is kind of odd when you hear it for the first time is you can actually get a lower interest rate if you put down less than 20%. Now, once you add in the mortgage insurance, I'm not sure if it makes that much of a difference over the life of the mortgage when you actually average it all out. But the reason why a bank is willing to give you a little bit of a better rate is because they're not as worried. They're insured, right? So if someone defaults on that mortgage, they have the insurance for it. They're willing to give a bit of a better rate. An uninsured mortgage, which sounds like kind of a bad thing, just means 20% or more, but they're not willing to give as low rates. Now, how it works right now is first-time home buyers in Canada, you can get a mortgage term up to 30 years. This changed with putting less than 20% down. This changed about a year ago. It used to be maxed at 25 years if you were putting less than 20% down. If you're buying a property now with less than 20% down, you can extend that mortgage from 25 years to 30 years. If you do that, however, your monthly payments will drop, but you will, if you live in that property for the life of the mortgage for the 30 years, you will pay significantly more interest. I'm not overly concerned with first-time home buyers because as I've seen in my own business, Steve, they move a lot. Like they're not staying there for 30 years in most cases. But it is just something to keep in mind. You have that option to bring down the monthly payments, but over the life of the mortgage, you get dinged a lot harder on the interest payments. So here's an example. This is based on a 4% interest rate, which you can actually get slightly lower in today's market. So based on $600,000 purchase, you're putting 10% down and a 4% interest rate. If you took a 25-year mortgage, your payment would be, $3,100 essentially. If you pushed it to a 30-year mortgage, your payment would be $2,800. So you can see, the monthly payment comes down, but if I showed you the breakdown, and I'm not going to get too in-depth on this today because we got lots to cover, but this is showing you those first 5 years of that mortgage and where your money's actually going versus principal paid and interest paid. And mortgage approval math, Steve, I want you to take over for this part.
Oh, okay. What am I talking about? No, I'm just kidding. Okay, so we are not mortgage brokers, but we know a lot of good ones and we kind of know what it takes. So generally speaking, in today's marketplace, you're going to qualify for somewhere around 4 to 4.5 times your income. That's for the borrowing. Now, that may be lower if you have a lower income because you're actually going to get involved with things like a percentage of your heating bill and strata fees or whatever it is you have. But generally speaking, that's what you're shooting for. Then you add your down payment on top of that, and that obviously equals your purchase price. However, it's not as simple as I make 75 grand a year, so I can get a $400,000 or $300,000 mortgage or whatever it is. You have to take into account not only your credit. I find credit's not as big of a deal these days as it used to be, but definitely other payments you have. And yes, your car payments are going to take away from what you can afford, your outstanding visa bills and all of that stuff. So the problem a lot of people make is when they go to get a pre-approval, they just walk into the bank, they tell someone I make 75 grand a year. That person goes, okay, you can afford whatever, how much do you have paid? You can afford 380 for a nice little 1-bedroom in my marketplace. And next thing you know, they check your credit and they find out that you owe a whole bunch of other money. But that's the very basic kind of plan of it. And then most people can actually afford a little more, even though you get a higher interest rate if you avoid the CMHC. So you can afford more, you can borrow more if you avoid and can get the 20% down rather than working with a minimum down payment. However, generally speaking, I find that the difference in the interest rate plus the CMHC, I don't know, it all kind of comes out in the wash.
And I just, the only thing to add to this is like, when you go to the bank, what they're gonna come back to you with is, here's the maximum amount of money
Yeah,
we're willing to lend you,
good
plus
point.
the down payment you have saved. It doesn't mean you have to spend that amount of money. You know, you don't have to go to the max. So just keep that in mind. Maybe the max is like, well, that's all I can get anyway, so I have to go to the max. But don't feel like you have to go to 100% of what they're willing to lend you. They want to lend you as much money as possible because they make a ton of money on interest. Steve, let's talk about the stress test, because a lot of first-time home buyers that have not been through the process are probably not fully educated on how this works. So take it away.
Well, the stress test just basically means it's like your kind of worst case scenario. So even though I'm going to get a 4% mortgage, the government, and this is actually, I think, what kind of saved our marketplace,
Yeah.
the government came in and said, even if you're going to get 4%, we want you to qualify at least 2% higher than that. So you're actually qualifying now in Canada at a much higher rate that you're going to get. That should, in theory, leave you with a bunch of money left over after your payments. You know, cost of living has gone up. It's not really the case. So if rates come down, the minimum that has to be qualified at is 5.25 currently. Used to be 4.75. But as I said earlier, they're always monkeying with this stuff just a little bit. So you have to stay up to date on it when you're purchasing. But the reality is you are being stress tested higher. And that's the government, what I'm going to say, putting in protections against ourselves,
Mhm.
right? Because if we are approved for $1 million mortgage at 4%, then at 6%, we might only be approved to 800, and that should be the fail-safe of having some money left over. So be aware of the stress test. You're not going to be qualified at what you can actually afford. You're going to be qualified at 2% higher.
It may have actually been the main thing that's going to stop all the mortgage renewals this year from being as bad as they could have been, because even if you took a 2% rate, you were stress tested at 5.25. And I think that is a very good thing for the overall like safety of the market.
Mm-hmm.
Um,
Might
as
have
we
been
continue,
475 at that time, but yeah,
oh,
close.
well, this stress test came in 2018. So anyone that's renewing a mortgage now would have been stress tested at 5.25.
No, 475, and then 2020 June 2022, it changed to 5.25.
All right. Well, we'll have to
Are we going to disagree
please
about that?
fact check this.
Okay, fact check us.
Either way, it doesn't matter. That has nothing to do with the people today. We know what the stress test is as of right now. Now, I wanted Steve to take this part because we're not financial advisors here today. We're not going to tell you how to run your life and save money. There is one tool that worked well for me, but Steve, I want you to quickly take a stab at this one. Talk about the savings for the down payment. What worked for you? What's worked for your clients that have got into the market?
So for overall savings, I'm going to assume most people here are first-time buyers. A lot of first-time buyers are still living at home. If you're living at home and your parents are nice and they're not charging you a massive rent, what I want you to do is immediately look at what the bank says you can afford and try paying yourself that now. That's a really good place for instance, the first home savings account, the RSP, and everywhere else. So if the bank says I can afford $2,300 a month and mom and dad are only charging me $500, I got to save that extra because it's going to get me used to making that payment and it's going to add up very, very quickly. But if you're renting currently and you're looking at getting in the market, rent right now is cheaper.
Mm-hmm.
It is cheaper than your purchase. So you got to do the same thing, because if you're going to get to that higher payment, you really have to get yourself used to making those payments. And yes, it's probably going to mean sacrifice in one way or another. I famously did a budget with a friend of mine one time. This was probably 15 years ago, maybe 13 years ago. And he said, I want to become a homeowner. We went through his budget and we found that he could not explain where I think it was $80 a month was going. And back then it was more cash. So he would get cash out on, payday or whatever. And next thing you know, it's Tim Hortons and drinks on Friday and all that stuff really adds up. So if you can get used to forcing yourself to pay first, I personally did that through automatic savings withdrawals through my accounts.
Mm-hmm.
But there's just so many ways you could do it. We could honestly spend a webinar just on this. I do have a video on my channel covering 15 different ways to go about this. And I think it a lot of people just say, oh, it's really, really hard to save, but I don't think enough people are taking those steps. And number one is definitely paying yourself first.
The automatic feature on your banking, transferring between accounts, this is how you're going to do it. Unless you're going to set a reminder every month to do it on a certain day,
Yeah,
but then you're
you're
gonna be
not
like,
going to
oh,
do
my
it that
day
way.
got busy. Has to be set up automatic. That's how you're going to do it. That's how you're going to follow the plan. I think that's great advice. Do you have any thoughts on this, Steve? Just for the mortgage approval side of things, bank versus broker at this point right now, early 2026, what most people should consider?
Definitely right now, I'm finding. I was always previously a broker person, always. I preferred it. I found that they shot me around, got me what I want. And actually, for my principal residence, I got a product that was not available otherwise that's really saved me a ton over the years. However, right now, the banks have finally realized, and this, I don't know when this will change, but in the last 6 months, the banks have realized that if they don't pay a broker, they can give you a better rate and they can get that business. So if it was me right now getting a mortgage, I would be going to a mobile mortgage specialist, I believe they call them. They're not actually brokers. They work for the bank, and they will undoubtedly at TD, at CIBC, and at Scotiabank, they will undoubtedly undercut a broker. So if you're looking only for rate, that's where I would head. I have no time for, unfortunately, I hope nobody's on here that's a branch worker, but I have no time for getting my mortgage at the branch. And right now, I'm finding that even something like Scotiabank, the mortgage specialists are beating the independent brokers at Scotiabank by up to 0.5%, and that's huge on your future. So I really recommend at least getting an opinion from a broker. But at this specific point in time, if you're thinking about doing something in the next 6 months, a mobile mortgage specialist at a preferred bank is probably the best way to go. I will warn you, I am not a big fan of having my mortgage and everything else in my life, like credit cards, at the same institution. So your bank might not be the right bank. Consider that as well.
Something to keep in mind too. This like going to the bank is the easiest and getting the best rate at this exact moment in time. This could
Exactly.
change very quickly because we've seen it change. Um, but just know as well the broker channel. If you're not like have everything perfectly lined up, no debt, great credit. Sometimes you're looking for other options. Sometimes the broker channel can take you to monoline lenders that are not the big banks and just do mortgages that could potentially get you better options. And the broker channel can still get you a mortgage from all the big banks other than RBC and CIBC. They are the only two that do not lend to the broker channel. Okay. Down payment versus deposit. I'll go over this very quickly. The down payment is the full amount of money you're putting down. The deposit is a portion of that down payment. So if you've saved 10% and 5% is your deposit, that is just being paid at an earlier process of the transaction. And then the initial down payment, once you have an offer accepted, basically about a week before closing, at least in Ontario, you set that appointment with the lawyer and you deliver a check or wire transfer these days that says, here's the rest of my down payment plus my land transfer tax, we're going to get to in a second, plus the lawyer fee, and here's everything all at once. Now, I want to spend a quick moment here just to give everybody a piece of advice that I really, it's going to sound kind of funny when I tell you this, and if you've watched some of my videos, some of you might know it today, but I call it the out of 10 rule. And I really want you to take this seriously because I promise you this is going to be the number one thing that will make sure that when you buy a property, you don't wake up in the middle of the night the next morning and you're like, what the hell did I just do? I just made a crazy decision. What just like, I don't even know if this is the right place. I don't want you to regret your purchase. That's a big thing for all the clients that we work with. So how it works in the real life is not like the real estate shows. If we represent you as a buyer, we're not going into each property and being like, look at this marble countertop. You should buy this. Like we're working for you. What's best for your situation. So here's how the rule works. Every property you see, I want you to rank it on a scale of 1 to 10. But here's the most important factor. You're not allowed to say 7. Steve thinks he's a 7 out of 10 looks wise. I don't know.
I'm
Right?
average. I'm a 5.
So so you can't say 7. And then the reason you can't say 7 is because I think it's just like it's like you don't really like it, you don't hate it. Why would you want to feel average about something that you're spending this much money on? Right? It doesn't make any sense to me. So the way that this system works is if it's a 6 or below, move on. It's not the right place for you. And this has to be done within your budget. If it's at least an 8, ask yourself, well, if I paint the walls my color and change the backsplash, and I'm talking minor things, does it become a 9? If it's a 9 out of 10, that's where you're in offer territory. Okay, I'm thinking about offering on this. And 10 out of 10s do exist. What I found, though, is perfect properties, priced correctly, even in today's slower overall market, sometimes still have competition. Because if you feel that way about it, there's a chance that somebody else feels that way about it as well. Okay, yeah, we got about 10 more minutes of this today, and then we're gonna get into the Q&A. Steve, I want you to talk about the offer process because we've talked about everything kind of leading up to it. There are 5 things that are important in every offer. Can you walk us through that?
I would say there might be 4 here in BC, but we can elaborate
Okay.
on that. So price is obviously where everybody focuses. And it is like, I'm going to say price is the king on a chessboard, but it's not the only piece on the chessboard. So there are other things that are very, very important. Everybody focuses on price, but I'm going to talk about, you say possession here. I'm going to call it dates. Dates of when you're going to complete can be extremely important to the seller. A seller may, if they need out quickly or want out quickly, they may give you a better price because your dates are faster. Or if they've been in the home for 35 years and they're worried about how fast, they may give you a better price if you let them stay longer and you're not eager to move in. So dates can be extremely important. Deposit can also be important because let's say, for instance, you were in a situation where you were competing for a property. It doesn't happen a lot right now in the entry level market, but it does happen. If that's the case and your deposit comes in, say, at 5 or 10 grand, and the competing offer is the exact same offer but comes in at 45 grand, we know who's more serious. So it's putting skin in the game. So it can be just as important. Now, conditions, the amount of conditions I find right now can play into it. A lot of agents may not view them as super important, but conditions and also how long those conditions are. Now, I know in Toronto, Tom, your marketplace usually sees a lot fewer conditions. We see up to 6 as being what they call standard. I think in this marketplace, if you have 6 conditions in a strata offer, your agent's probably a little lazy and not showing you stuff you should do in advance of the offer anyway. But if you have less conditions and you're trying to get the price down, it's not a very smart negotiating position to go in at a very low price and lots of conditions. Like you're giving the seller no wins, so they're not necessarily willing to work with you. Now you have something there called an irrevocable, which is, you can explain it. Maybe it's a date of which
It's just
the
how long
contract
the
is valid.
offer it's how long the offer is valid until. So if we made an offer right now at 7:44 p.m. Eastern Standard Time, we would probably give them till 6 p.m. tomorrow night to respond to it, or noon tomorrow, depending on the situation. In hot
So
markets, it's very short. In today's market, where 24 hours is not that uncommon to see.
totally. So we do have a date of how long the offer is valid for. However, that's only to accept the offer and not necessarily to negotiate the offer. And it's not irrevocable. I can revoke it, no problem. So I could phone the agent and say, you know what, you took too long to respond. My people don't want to get into multiple offers or whatever it is. They're moving on to another property and we can revoke the offer. So little differences that are there for us for sure.
One thing I wanted to show too is these are the common conditions that we find here, at least in the city of Toronto. So financing. So even if you're pre-approved, well, why would you need a financing condition? So when the bank's pre-approving you, they're pre-approving you. But if you go out and overpay for a property, they're not necessarily approving that. So financing is typically a 5 business day condition here in the city of Toronto. And the way, and I can only speak to Toronto right now, but the way that we write these in for our clients is that it basically says, this offer is conditional upon the buyer receiving, and then this is the word that's the most important: satisfactory financing, being satisfied with the financing. It's vague on purpose to protect our clients. So if we do not get the financing we're looking for, you are fully protected. You get your deposit back. Okay. So these conditions are put in there to your benefit. The status certificate condition here, if you're buying a condo, that is reviewed by a real estate lawyer that we typically recommend to you, someone that we trust that's really good at this. What would be in the status certificate? How much money is in the reserve fund of the building? Is there any upcoming increases to maintenance fees? Is there any special assessments where there's going to be a large sum of money that you owe at once? And most importantly, is the current owner up to date in all their payments? Because if you buy a condo from someone that hasn't been paying their maintenance fees, they're going to come after the new owner, right? And then also, is there any ongoing lawsuits? I'll tell you, there's lawsuits in almost every condo status that we look at. A lot of the
Really?
time, they're not super scary. You see a lot of slip and falls and things like that. But the real estate lawyer is the one that is allowed to actually go through this, give you an opinion on it, and say, okay, this looks good. It's healthy. The reserve fund's good. There's obviously going to be some things that we don't see always, and that's where a local specialist comes in to tell you what are the good buildings, what are the bad buildings. And then home inspection, I think everyone kind of understands what a home inspection is, but that is typically a 5-day condition as well in the city of Toronto. We have great home inspectors. You can do it for condos or homes. They're more typical for homes, and we use that word satisfied as well, so that our buyers are always fully protected throughout the process. Steve, is there anything to add to that?
In BC, it's much more involved. So we obviously have financing inspection in most of our offers. Strata documentation is a very long list. You're going to get 2 years of minutes. You're going to get strata bylaws, a lot of stuff to review. BC has had some extreme, and this is probably the biggest thing, extreme problems with insurance, particularly in high-rise condos and other condos. So not only reviewing your own insurance for your property, but like the contents and improvements of your property, but also the strata's current insurance is a big deal.
Yeah.
And then there's title to review and property disclosure. So things like when I say your agent might be a little lazy, if you can get the disclosure statement in advance, and BC, I believe, is the only province that does disclosure statements. But if you can get it in advance and review it, why make it a condition and why make it another objection if it's a 2-page document that you can review prior to making your offer? Because if there's a deal breaker there, let's just move on to another property. So I would say there's more to it in BC because we've come across so many issues in the past.
Now, the last two topics we want to cover, we're going to talk about closing costs in both Ontario and BC. And then Steve's going to go over a few market metrics that we tracked on how to become a more educated buyer in terms of what is going on. There are two main closing costs, okay? There's land transfer tax and there's a real estate lawyer. And how much you spend will depend on the land transfer tax. Now, both of these closing costs are outside your down payment. These are both cash on closing. They cannot be put into your mortgage. They are separate from your down payment that are going to be what's given to the lawyer on the closing date. So I'm going to give you an example today based on if you are a first-time home buyer in the city of Toronto. Now, we are very lucky here in the city of Toronto, Steve. We get to pay 2 taxes because we're Toronto. I'm not a huge fan of land transfer tax at all. I think it needs to be adjusted. I think that the rebate needs to become bigger for first-time home buyers, but I'm not going to go on a rant tonight. How it shakes out right now is that if you bought a property for $600,000, you would pay $8,475 in provincial taxes, and then you pay the Toronto tax, which is the exact same amount, but you get the full rebate. So the maximum rebate, it's a bit confusing because they're all the same number, but the maximum rebate you can get, and that is the first-time home buyer rebate, maxes out at $8,475. And if you're buying really anything over like $550, you're usually going to max out the rebate anyways. It only, if you're under 400, it's a lot different. You're not getting hit with as many taxes. So in this scenario, after getting your first-time home buyer rebate, which is not a rebate, it's not like you pay it and get it back. It just comes off the top. Your land transfer tax on $600,000 as a first-time home buyer in Toronto will be $8,475 if you're buying in the city of Toronto. Now, if you're buying anywhere else in Ontario that is not Toronto, your land transfer tax would be $4,475 because there is no municipal tax. Okay? So significant change if you're buying in Toronto versus anywhere else in Ontario. Steve, I'm going to let you take over here for the British Columbia side of things,
To be clear,
because
that's for first-time homebuyers. That exemption of that 84 whatever is first-time homebuyers only. If you're not a first-time homebuyer, you owe the
you
whole
owe
thing.
you owe plus that. Yes,
Okay,
correct. Yeah.
cool.
BC is a little bit different. It's not as bad as Ontario.
Well, it's not as bad as Toronto. It's also changed. So up until recently, within the last couple of years, if you are a first-time home buyer and you qualify for the program, and there is stipulations to qualify, they're not crazy, but there are some stipulations. If you only got the exemption if it was up to $500,000, and then you had to pay no transfer tax. But if it was $501,000, you had to pay all of the transfer tax. Thankfully, now they've adopted a bit more of the credit system like you guys have in Toronto, Tom. So now there is an exemption, they say, of $8,000. And then you, as a first-time buyer, only have to pay a portion all the way up to 835. And then between 835 and 865, there's a sliding scale. After 865, you got to pay the whole thing. But for instance, in this case, you use 600.
Mhm.
If I was a second-time buyer, my transfer tax would be $10,000. In this case, as a first-time buyer, it's only two.
A lot cheaper.
So it's a substantial thing. And actually, we're just dealing with a client right now where we're trying to get clarification on one of them is a first-time buyer and the other one's not because they're married now, right? So then what does that look like? There is going to be some savings there, but they have to get advice from an accountant and a lawyer just to make sure they're closing on it correctly to save the correct amount of money, because saving the most amount of money isn't always legal, and they will come back after you for it.
Real estate lawyers, what I typically find is that it ends up being roughly $1,500 to $2,000. A real estate lawyer here in the city of Toronto would help you review the stat certificate. They would actually also help you close on the property. Okay, so that's where they really come in during the conditional period, and once the property is sold firm, between the firm date and the closing date. Real estate lawyers market in different ways. So a lot of times you'll see like $8.99 and you're like, oh, great, that's cheap. And then it's like, oh, plus disbursements. And then it ends up being $1,600.
Yeah.
So ask them up front, what is the typical amount that I'm actually paying on the closing date? I like the lawyers that we work with here in Toronto. Zachary's been great. Happy to recommend his name to anybody. He's upfront with his fees and there's no surprises. So other than your down payment, you've got your land transfer tax, which is the big one, especially here in the city of Toronto. And then you've got your real estate lawyer. Those
Can
are
I
the
ask you a
two.
question, Tom, about
Yeah.
that?
Yeah.
That when they review the status certificate, do they have an upfront charge, or is it built in like that's the guy I'm going with to close?
That depends on the lawyer. It's a bit
Okay.
different these days. In the hot market, lawyers were charging like $150 to review them because we were reviewing them before the offer dates, and sometimes we'd have to review like 10 of them. In
Yeah.
today's market conditions, I
They let
haven't
it
seen
slide.
clients get dinged for reviewing too. Like usually the lawyers understand it, right?
Yeah. Cool.
Becoming an educated buyer. Before we wrap up to the Q&A section, there's just three things here I want. I know a lot of people here are going to be educated on this if you've found me and Steve online, but Steve, can you briefly explain why these would be important to the people on the call today?
If you are a buyer in the marketplace right now, you need to understand these in any marketplace. And I don't think a lot of people do. They focus on, is the kitchen nice? Is the square footage good? But what is the actual market doing? These are your metrics. And I'll give you an example of how you use them against each other or with each other in order to make sure you're offering the right price. Now, months of inventory is very simple. It sounds fancy, but it's just the active listings on the market divided by how many listings sold in the last 30 days. It gives you a number. The lower the number that is, the hotter the market is. The higher the number that is, the better it is for you, the buyer. It's a buyer's market. Now, there's some debate on exactly what these numbers are, but months of inventory, 3 or less, is generally regarded as a seller's market or prices are going up. 4 to 5, and I really think 4 to 6, like 5.9, is a balance market. The BCREA says that 7 and above is a buyer's market. I really think it kind of starts at 6 or 6.5. And just so you know, in some of our markets right now, we're looking at 14 months of supply. Now, as Tom and I have discovered, just because you go from 7 months supply to 14 doesn't mean the buyer's market has doubled necessarily, because it is kind of a ratio. But if you are in one of those markets, you want to know, okay, are prices going up? Are they staying flat, or are they coming down? The next number to look at is what we call list to sale ratio. List to sale ratio is just a percentage of the actual sale prices happening in the neighborhood compared to what they were asking at the time. Generally, in most marketplaces, it's going to be 96.5 to 97.5, maybe 98%. Once it goes north of that, again, prices start going up. If it goes south of that, it's a pretty good market to be in as a buyer. So list to sale ratio will kind of give you an idea, you know, how much negotiation room do I have in this marketplace? It's not specific to the listing, however, because there may be people underpricing or overpricing. The next metric then we use, or the last one, is average days on market. So you will be able to see on the listings how long the property's been on the marketplace. Let me give you an example of why this is so important. So let's say the average home is selling in 28 days in my marketplace, and it's selling for 97.5%. So if we see a property that's now 60 days on market, in my mind, I can kind of use that as a metric. It's at least 2.5% overpriced, if not more. Or if it's 2 days on the market and it's good enough that we should be offering on it, we're probably going to be a lot closer to that asking price. So it's kind of like a bit of a fulcrum point where you can go, okay, this is my average list. This is my average time on market, or percentage of list and time on market. Now, where is the listing I'm interested in on that scale? And it gives me an idea of where I should likely be offering in order to get market value. Now, you should definitely heavily rely on your agent, and they'll kind of guide you through these numbers in your area. But I think if you understand these three things at a pretty intermediate level, you'll feel more comfortable knowing which properties are the good ones and what to offer on them.
The way I've always looked at average days on market is it just tells me if it was priced correctly, it would have sold by this amount of time. That's kind of what it tells me. So if you're looking for, if you see a great property, it's day one on market and we think it's priced around where it should be, it just usually the sellers are less likely to negotiate down early on. But once you pass whatever that number is for the market, that's typically when there's more negotiation room. And the last thing I'll mention on this is, I think a lot of buyers look at listings and go, oh, well, I've won the negotiation if I got money off the asking price. Which makes sense, but it's not always the case. So if a property is 100 grand overpriced and it sells 50 grand lower, not necessarily a good purchase just because you got 50 grand off the price. And sometimes, we had one at the end of last year where I thought they completely underpriced it and we got it at the asking price, but I thought it was 20 grand lower than market value, but we paid 100% of asking. So just keep in mind, like, not everything is perfect when you do these calculations. We're going to move on to the Q&A section, but just before we do that, and I recognize it is almost 8 p.m. Eastern Standard Time, so we're going to stick around another 10 minutes at least to answer questions. If there's anything specific you want to talk to me and Steve about, you can go to our Instagram accounts, you can go to our websites, our YouTube channel, send us messages, and we will connect with you after this. And we also want to let you know that we know there's people from all across Canada on today's call, and that if you benefited from this in any way, we told you there'd be no sales pitch tonight, and that is the truth. But if you find that you connect with how me and Steve, run our businesses and work with our first-time home buyers, and you want to connect with us, you can fill out this quick form only if it's interesting to you, and we will connect with you. And what's so great is that because we know there's people from all markets across Canada on this call tonight, is that if you're not looking to buy in Greater Toronto area or Greater Vancouver area, we can also connect you with people that we trust, and like people that we actually trust, that if we move to those markets, those would be our real estate agents, not some random person we found online. These are people we personally know. So I'm going to leave this up here if you want to scan it. It's just it's like a Google form. It's really simple. There's like 3 questions on it. You can get more information. If you think that you learned something tonight, if this was beneficial to you, we would love the opportunity to show you what it's like to work with our teams. I'm going to leave this up here. Steve, can you see the Q&A?
I can. The question is, can I read better than a 5th grader?
Because I can't see it. So if you could tell me what the questions are, that would be great.
Sure. Well, you want me to start right at the top? Let's go for it.
And just keep in mind, like, we can't answer every question. If we deem them inappropriate, we will skip them. I don't know what's in there. Just so people know. Yeah.
Okay, here's one. How about court-ordered sales? How does the closing look in BC? So I can definitely answer that. If you are a first-time home buyer, please avoid court-ordered sales. They come with an immense amount of risk, and you're not going to get a deal. You will actually likely sell for over the asking price. That being said, the court order will execute the closing date. It's usually either 21 days, 28 days, or 35 days, something like that, past the court day. And you may not also default on a court sale. So think about that. It is a court order. If you buy a court order, you're not buying real estate. You're getting ordered to buy real estate. So don't defy it at all.
And Jeff, I know you're in here too. If you could put in the Q&A, if it lets you, put the link to this QR code, because in a second, I'm going to stop sharing the screen in about a minute. Steve, what's the next question?
If you go to a provincially regulated credit union, can you avoid the stress test? My understanding, Tom, correct me if you know, we are not mortgage brokers. My understanding was the credit unions originally were not tied to any of this, but their kind of view was if the big banks are doing it, we're
going
doing
to follow.
It too. Right.
So
So
that was my understanding too. Perhaps there is still some that don't follow, but the way that we understood it is that they did follow what the regulations was for most scenarios. But go in and ask them and see what they say.
totally. Brock, that's from Brock. So he's got a bunch. So I'm going to come back to some of Brock's questions.
Cool.
Any tips, Tom, to find a mortgage broker or organization, or any organization is doing it, or individuals? I don't understand. But so, let's say you're looking for a mortgage broker. Any tips on how to find a good one?
Well, I mean, normally in these scenarios, it's word of mouth. So like I have 2 mortgage brokers I've worked with for the last decade. And when I refer clients to it, one thing I'm very clear with my clients about is I don't get any benefit. I don't get cash back. I don't get points. I don't care about any of that. I just want someone to be good and take care of my clients. So that would be the big thing. If you're getting referred to a mortgage broker, make sure you understand is the person that's referring you getting something from it. That's not how me and Steve do it. So if you're looking for someone in Ontario, I have great people I can connect you with if you want to connect with me after this. And maybe Jeff, actually, you could put in the Q&A both me and Steve's email, just so people have, or maybe Steve, you can do that if you have access to it. You can reach out directly, and I'm happy to share names with you. But for most big decisions I make in my life, I ask someone that I trust what their experience was and if they'd recommend the person that they worked with. So I would recommend that. Or if you want someone great, I can connect you with them as well.
Eric asks, is the deposit different from earnest money? Earnest money is a deposit, I'm going to say. Earnest money is technically most often a American term, U.S. term. So it may differ slightly, but generally speaking, one of my best friends is a realtor in the States, and he uses that term earnest money all the time, and I had never heard it until he used it. So basically,
that's actually the first
deposit.
time I've ever heard that. So thanks for answering that. Yeah.
There you go. What are your thoughts, Tom, on buying an older home and spending money for renos versus a move-in ready home?
Yeah, that's a great question. So this is actually like I'm in this mindset right now because I want to upsize soon to a bigger house. And the options are buy a really good lot in the neighborhood I want and slowly kind of reno it to where I want it to be, or buy something that's been fully gut renoed. Like there's a house across the street from me that sold recently, and it's gorgeous. Like it's amazing. They did a great reno, but the lot size isn't that big. And I'm like, that house is at its full potential. So personally, for me, I'd buy on the things I can't change. I can't change the lot size. I can't change the location. I would be buying on that and then renovating it the way I want to. This is, of course, if you have the means to do so and you have those extra funds. Because when you buy someone else's reno, the bank's kind of financing it for you with the mortgage. If you're doing your own reno, that's your own money. You know, obviously there's line of credits and some banks will still do purchase plus improvement. But in my own eyes, maybe I'm just answering this for myself, I'd rather buy exactly what I want for the type of house, and then I'd make it how I want it to be. Unless I found something that was already that and reno, then perfect. If you could afford it, then that's great.
What I'm finding buyers are doing right now is like it's expensive to get into the market, so there's not reno budget left over.
Yeah.
So believe it or not, they're usually paying when before they wouldn't pay extra because they'd be like, yeah, you put in a kitchen for 30 grand, but to me, that's only worth 10 or 15.
Mhm.
Now I'm finding that it's actually selling for the 30 grand or higher because there's no money left over to do the renovations themselves. Um, do you recommend title insurance?
I believe you have to have title insurance. I think that's a
Yeah,
question with a lawyer, but I believe you have to have title insurance to close on a property in Ontario.
often your lender will require it
Yep.
here. It's either survey or title insurance
Okay.
previously, but with all the new stuff coming out with land claim, it's just for the $400. It's
I
cheap money.
highly
Like it's not
recommend it, and
super
I think it
expensive.
is mandatory in most circumstances here.
Um, Real estate lawyers do not read condo bylaws. Um, Once you move in, you're in for a shock. Do you think that is the case? I mean, here we review condo bylaws like with our clients. So is there bylaws? How does the bylaws
Yeah,
work in
we have
Ontario?
bylaws. I mean, our lawyers do review the bylaws with our clients. So I think it just depends on who the lawyer is. I will say, most real estate lawyers have specific sections of the staff certificate they go to find the main things that they care about.
Hmm.
But they can get more in depth if you ask them to. But I agree. Yeah, you got to know who you're working with and what they're reviewing and making sure they're giving you the right advice.
Can you name some good websites for the public to watch listings? I know Realtor.ca and House Sigma. Are there any others? I have a very strong opinion on this. Are there property auction sites in Canada?
I
I
mean,
got
House Sigma honestly is probably the easiest, to be truthful with you, but they are a real estate brokerage, just so you know.
Mhm.
They're not doing it for the in the good of their heart. Okay, they're getting your information and trying to convert you as a client, which isn't a bad thing. But just so you know, I believe Realtor.ca, Steve, is actually they're going towards They're going to start showing sold prices. Um,
They already do,
do
but
they?
they're tightening up the window on that. Like
Yep.
originally it was like 6 months or 90 days after it sold.
Mhm.
Here's my piece on this. If you're shopping anywhere other than Realtor.ca, you are the product being sold.
Mm.
So Realtor.ca is owned by the agents in order to have one place for everybody to go look. And if you message a realtor on Realtor.ca, you get that realtor. If you message a realtor on, for instance, REW or one of these other sites, your lead, you are a lead now and you get fished out to somebody who's not even the listing agent.
That
So
pays to get a chance to talk
that
to you.
pays to get a chance to talk to you. So, in my opinion, use the website that your agent sets up for you after you sit down and talk about the criteria. But if you're searching publicly, use realtor.ca. You are not the product there. However, realtor.ca doesn't necessarily always have the best experience. So once you find a property, you may do some more Googling.
I think even if you're not actively searching, if you've got a realtor that you plan to work with in the future, get them to set you up on their program because it's
Oh,
much more
okay.
intuitive than what the consumer facing ones are. But the simple answer is actually yes. Like the best user experience is House Sigma in Toronto. That is the truth. What's next,
Can
Steve?
you go over the out of 10 rule again, real quick, just so somebody can understand it exactly?
Yep. So every property you go into, and this is within your price range, I want you to go see the property, and it's going to be a gut feeling thing, right? You're going to walk out and you're going to say, how would I rank that property out of 10? But you're not allowed to say 7 because 7 is average. So it means 6 or below. If it's 6, if it's from 0 to 6, move on. Don't think about that place again. This is not the right place for you. If it's at least an 8, I just want you to think, could I make some minor changes here to make this a 9 out of 10? If you walk in, you're like, this has the view I wanted, it's the space I wanted, the price points in my budget. This is great. And it's a 9. That's when you look at your realtor and go like, okay, what do I need to know about this to move forward? And that's where the realtor can step in and walk you through the offer process, negotiation, why you're starting at a certain price and how the seller is going to respond. And if it's a perfect 10, I mean, kind of self-explanatory, but even in slower markets, we've found that perfect properties still sometimes get multiple bids. Doesn't mean they sell over asking price because of where we are today in the market. But that's the out of 10 rule. And I found it's very beneficial to make sure you never regret the decision that you're making, especially when we're spending this amount of money on your first property. I don't want people to regret it.
I've heard another version of this where a realtor friend of mine they encourage their clients to only have one listing in their hand, or sorry, two listings in their hand, because you're only buying one property. So let's say you go tour 5 or 6 properties. It's like, here's the first one, they get the paper. Here's the second one, they get the paper. By the time you see the third one, okay, which one of these have you
You
removed?
got to drop the
Like which one?
paper.
Yeah, so you got to like
Yeah.
be like, okay, I'm looking for the one. I'm not looking for not the one. So what do I have all these other papers in my hand for? I'm looking for one of the good ones. So it's a fun
So
way to do
maybe
it.
Steve, are you good for 10 more minutes? We'll speed round
Yep.
this and then
Yep.
we'll try to get
Yeah,
to every
there's
question.
some good questions here, so I definitely want to get to them. Toronto first time home buyer here, welcome. Thanks for the great webinar. You're welcome. What kind of research do you expect your favorite client to do before contacting you for your first call, Tom?
You know what?
And they actually said Tom, not Steve. So
I don't expect any research. That's kind of my job. So like that first call is where we go into a much more specific version of what we talked about tonight. And we get into things like when you're buying a property, is it going to be owner occupied, vacant? Are you going to take the chance on a tenanted property? Like we get really in the weeds about the market and what the trends have been. So yeah, some people come in knowing nothing, which is great. Some people come in being extremely educated because they've spent 6 months online watching videos, learning what's going on. But no,
Mhm.
I don't have, you don't have to come with any specific knowledge. That's kind of where we take over and try to guide you through the process. So thanks for the question.
I would say one of the things that I find, I don't want to say frustrating, but I'm flabbergasted by it every single time. And Tom, I sent you one the other day, is the amount of people that have written an offer with another agent. They don't feel like they're getting good service. And then they come to me and say, help me with the rest of my transaction. And we cannot do that.
Yeah. So if you're
So
signed with another realtor, we're not allowed to give you advice.
not only signed, but like working with or whatever, you're in a
Yeah.
transaction. It's a matter of, okay, listen, you need to hire the person that you trust first.
Mhm.
And if they're not performing for you, make sure they are. They're going to get paid a lot of money. Don't put up with somebody who is necessarily, oh, I can't get there this weekend or I'm too busy. If a realtor says they're too busy for you, I mean, this is why you and I have teams, right? We
Mhm.
want to make sure that we can stay married, have kids, and perform at a high level in the real estate market. So that's why we have teams that can help us with that and follow our processes. So I really caution you. It's a lot of the time you're going to pick your uncle or your mom's realtor, do some research and try and find out who you think you're going to work well with. And little hint, the people that give you lots of information are usually the ones that know a lot. The one that's like, hey, do you want to go run out and look at this home because I think it's right for you?
I'd actually say
Not the right person for me.
the first red flag I would be if a realtor was just like, okay, I'll go show you the place right now, and you're trying to buy. Like we don't really ever take out any buyer to view properties unless we've had an hour like full Zoom or phone call consultation with them, getting
Yeah,
them prepared. Yeah.
correct. Correct. Um, this is a little bit about the market, but where do you see interest rates going, say early April? I'm near Ottawa in a smaller city about an hour away.
I don't really see them changing that much. And if there is a change, I'm not sure it's going to be meaningful. And I'm saying that both on fixed rate and the variable. Um, yeah, at least by April, I don't see anything changing significantly for interest rates. I think we're going to be in that 3.5% to 4% range, or maybe slightly higher than 4, at least for the first half of this year, and then we'll see what happens with any other economic news that surprises us.
Here's a tough one. Anonymous. They didn't even put their name. How do you know if a realtor is trustworthy?
You know what is actually, that's a good question. One thing I used to do when I was earlier in my career, when I'd meet with sellers specifically, because I still kind of look younger than I am, or maybe I just tell myself that, is I'd
Mhm.
actually say to them like, if you want to talk to the last 3 sellers I worked with and help them sell, I've already chatted with them and they're willing to talk to you about, and they'll be honest about the experience. So
Mhm.
if you say to your realtor, like, I'm interested in working with you, but could I talk to 2 or 3 of your past clients that you recently worked with? Would they be open to chatting with me about the experience? If they're like, oh no, like that's probably someone that's not trustworthy. But if
Mhm.
they're like, yeah, like here's some names. And obviously they get permission from the client, but I've had many clients that have been like, hey, would you be open to chatting with someone else? They're looking to work with us and they'd love to know what your experience was like. So maybe you could try
Mhm.
that.
Yeah, I find that people just don't, it's the hardest thing to do because you like someone, you trust them, you know they're an agent, but you don't actually know if they're ethical. You don't know if they do business. It's really kind of tough to do. So you can ask those questions like, how much do you sell? How often do you sell? Like what, there's stuff you can ask. But honestly, I find the real estate agents that I know that I do trust, they're usually the most transparent.
Yeah.
And
Yeah.
and they're not hiding something. So if you ask them, yeah, I mean, they can't give you client details, but if you ask them about certain things, they should have an answer. For me, I'm a stats guy, so I definitely want somebody that knows the numbers. But I want answers. And unfortunately, a lot of people just want to get hyped up about the property and doing it. And they just put a lot of trust in somebody. It is probably one of the hardest things to do to find out if somebody is actually good. Definitely tough. I don't know. I think we should probably come up with a better answer in the future for that one, Tommy,
I think that
because
was a decent answer. Yeah.
it's definitely a tough one. Okay, I've skipped around a bunch. What else do we got here? Can you get slightly more than 4 times your income if you have no debt at all, no credit card debts, no car payments?
Slightly more, yes, because I think
Generally,
four
yes.
and a half is kind of where it maxes for most people. And if you're buying with a significant other, like that's combined income, right? Should also say that for going back to the beginning, the first home savings account and the RSP, those are also double. If you have someone else that you're buying with, you can both take advantage of it.
What do you recommend for an emergency fund in terms of months after you pay the down payment and closing costs? Are you an emergency fund guy, Tom?
Yeah. So for me, it's 6 months, which might
Okay.
be more than most people. I think 3 months is what a lot of people would say. I'm a 6 month guy. I don't want to be stuck in a bad position.
Okay. I'm of the mindset that a lot of people aren't going to have that money yet. So I am a save 10% person. So if you're a new home buyer, whatever it is, once you're in, start saving. Start saving as best you possibly can. Um, there was one I saw a little bit earlier, something about before or after tax. It's definitely, when we're talking money, we're always talking before tax. We don't know your tax situation. So if you're talking income, it's usually before, not after. Um, any advice you can give a first-time home buyer, be on a single income? Besides get your income up, Tom, what do you got?
Yeah, besides having a single income, is that what the question
No,
was?
no, like a first-time home buyer that's on a single income. Do you have any
Oh, that's on
recommendations?
a single income. Well, I think you're gonna have to make a tough decision where it's like, I don't know where you're asking the question from, but you're gonna be capped to some capacity based on a single income unless you have help from family, where what you can probably afford in the city that you're currently in might not be your dream place. So I guess my piece of advice would be, I didn't love the first property that I bought, but it got me into home ownership. And even if the market didn't go up, I'd still own some. Even if I had to stay there from the second I bought it until today, and I didn't move several times since, I'd still have a very low mortgage and a cheap living situation, where rental prices really went up over that period of time. So I think that would probably be my advice.
Okay, I'm gonna truncate this one a little bit, but other than rate, what
Hmm.
else should be a
Good
consideration on a
question.
mortgage? Massive question.
Good question.
You want me to go?
Go for yeah. This is perfect for you. Yeah.
Okay. Penalty is huge. You cannot usually calculate in advance unless you have a variable rate. So I've seen tens of thousands of dollars worth of penalty because somebody wanted a slightly better rate. Don't focus on rate as much as penalty, um, because a lot of people don't end up at the end of their 5-year fixed rate. If you take a 5-year fixed rate at one of the big five banks, your penalty will likely be enormous. So if you're going
I
to do
can
that, make
confirm
sure you're
that.
going to
I
stay
can
there.
confirm
Yeah.
that statement.
So definitely that. Like for myself, as becoming a bit more established over time, I switched to a heavy HELOC portion. I have a fixed portion, but also a HELOC portion. And that was just such an amazing tool to pay down because I have fluctuating income. Um, but the amount of penalty is definitely going to be a big thing. The amount of prepayment options if you think you're going to get raises in the future and you want to pay stuff down, Tom's currently becoming a good little pay down guy. He's that's usually what you do between 35 and 45 is pay down your mortgage. It can be a big thing because if you're not allowed to prepay, then the amount of interest they're getting out of you is at its maximum, and then you have to save. So prepayment options are nice. Double up payments are nice. All this kind of little fine print stuff. There's a bunch more fine print that you're probably not going to avoid anymore, like clogging your title up to the full purchase price can be a problem. Total indebtedness. This is why I say don't, not financial advice. I don't like to have my debt unsecured at the same property or same bank as my property is secured, because I do foreclosures and I do a lot of bankruptcies. And I'm telling you, unsecured debt at the same institution is as good as secured debt. They have fine print that will get that money out of you. So if you ever end up in financial trouble, you do not want your mortgage and your credit cards and your business loans at the same place. Take them elsewhere, spread them around.
And just before we go to the next question, so you just want to remind everybody that's still on the call, the QR code that's in front of you right now, if you did want to connect with me or Steve personally, or a realtor that we very much trust, that we know personally in any markets in Canada that we do not service, you can scan that QR code, fill out a quick Google form, and we will reach out to you. We will not spam you. We'll reach out to you, see what time works best for you, and we will discuss the more specifics of the situation. What's next, Steve?
Here's one. Recently bought, closing in a month. If you could go back and give first home you a piece of advice. Oh, okay. Okay, let me make this clear.
Oh,
You're
that's
closing
good.
in a month. I'm not giving you any advice.
That's
What
not the
advice?
question. It said first home you. When you bought your
First home
first
me.
place, what do you wish you knew?
Um, First home me, maybe not. I don't think I have any regrets. Second home and third home me, I wish I would have bought more home. I didn't go to my more maximums and get bigger homes that I could have afforded. Um, and I moved each time as a result of it. Like, for instance, when I went to the townhome, I could have stretched and got to the detached and I would have been in a way better position. But I didn't do that. That's probably my number one. I actually
Yeah,
wish I went bigger.
it sounds realtory to say that, but the truth is the cost to move,
Mhm.
we have fees obviously involved with us. And then just the land transfer tax to
Yeah.
move. It's like, if I make my next upsize, I'm going to be hit for like 70,000 plus in land transfer tax to move. Where if I just bought a bigger house, which I could have last time, but I was like, I don't need it.
Yeah.
So moving is expensive and costs a lot of money. So as long as you can afford it, if you can buy more, you'll probably stay there more and have less cost along the way, right? So I'd rather have a client not call me for 10 years because they love the place versus call me in 2 and they're like, we gotta find something bigger.
Yeah. I'll give you
Um,
an example of that. So if somebody's looking for, let's say, a 650 square foot one bed and den at a certain price, or they could spend 30 or 40 grand more to get into a proper two bed, two bath, plus maybe a den even, and they only have to spend 30 or 40 or 50 grand more. For my business model, it's great if you buy the place because you're going to outgrow it, like the smaller place. But for your well-being in the long run, if you can stay in that property longer, do it. Especially if you're young, because you're going to meet somebody, you're going to get married, you're going to have kids. If you can buy up, often it works out better.
I was also under the impression when I bought my first place, I'm like, I'm gonna live here for 10 years. And I think I moved in 3 and then the next place for 4. Like I just jumped
Yeah.
around so much because my
Yeah.
life changed. So I think I would want to go back and tell my 23-year-old self, like, the things you care about now are not things you're going to care about in 10 years from now.
Yeah, totally. And that's true. I lasted in both of my first properties, first two that I lived in condo and then townhouse, 4 years each, almost to the day.
Hmm.
The detached home we've been in a lot longer.
All right.
I
We should
think that's
probably
about
wrap
it.
in 5 minutes just to give people their evenings. Is there a few more questions, Steve?
Um, there's a few, but I think we should probably wrap up unless
Okay.
I find anything here that's crazy.
Well, I want to thank everyone for being here tonight. Honestly, me and Steve really appreciate that you hung out with us. And I watched like I think we got up to over 90 people at some point, and a lot of people stayed here the entire time. So I want to thank you for being here. I really, truly hope that you learned something new tonight. I hope that you found this valuable, that you walk out of tonight's webinar thinking, okay, I'm in a much better position to potentially buy my first property, knowledge-wise, education-wise, than maybe I was, an hour and 15 minutes ago. So really do appreciate you all being here. I hope this was valuable. We love feedback. So if you want to reach out to me and Steve and tell us if you like the way we did it tonight, if there's anything that you want us to change, constructive criticism for the future, or if you hated it, you can tell us that as well. But we tried to keep it to the point, simple. Here's all the things we want to know. So just want to thank everybody. Have an awesome evening. Steve, anything else you want to say?
That's it. Thank you so much. I appreciate everybody. Honestly, yeah, if you do need connected with somebody that we trust, please reach out. We'd love to connect you because it is hard to find good folks, and we think we know a bunch of them.
Thanks, everybody. Thank you so much for being here. And check out the Tom Storey Show. We're almost at episode 200, and we've got 2 really big guests coming out. Have an amazing evening, everybody, and we'll talk to you guys soon. And we will send the slides, and we'll send the recording. Bye.